Okay, so first, as I was mentioning, we have three parts to the meeting: 6:30 p.m. the debate, 7:15 Morocco on, in particular, option spread pricing, and then around 7:40 Dan on tasty trade. Let me introduce our speakers here briefly, and one of them is Rocco, who you're already seeing there. And Rocco is big in SaaS. He's a leader at SaaS, but more importantly for our purposes, he's an expert option trader. He runs his own training offering in Italy for training in options. And most important for our purposes, he's an experienced trader, quantitatively oriented, and that is in every aspect of quantitative trading. Then we have Dan Queen, who is another excellent person to answer some questions we'd like to ask tonight on how to trade options, because what he has is a totally systematic approach to trading earnings and some other earnings trades and general options trades as well. But I think he's just an outstanding example. Both of them are outstanding examples of people who are professional, quasi-professional, who are almost the equivalent, the skill equivalent of professional, but are actually non-professionally employed in options trading, and yet have been trading for many years, and I firmly believe, both very successfully. So what we said we would do is start to try and gain insight from their wisdom and their experience on a lot of issues that are popular and difficult and perhaps challenging for everyone. And I thought one way to do it is to try and state a controversial statement and ask both of them to comment on it. And because I think, and I also ask everyone here to also join in. So here's one, and if it were a debate, which it isn't really, but we can sort of pretend it is, then you would have a resolution. And the resolution would be options traders is for suckers because you can expect to wipe out your account. And I just put a couple of quotes I found offhand on the web there. Only 10 to 15% of even professional fund managers even beat the market. And another study done at the University of Florida found that traders are losing money consistently over 1, 2, and 3 day periods, at a rapid rate. And so let me ask our panel of Dan and Rocco, how do we, I imagine, well, let me just ask you to comment on that. Anybody who wants to go first, go first.
Well, I can start. First of all, thank you for the presentation. But I wouldn't claim myself to be an expert. I think I'm still learning as everybody else. So I appreciate your very good introduction. But I'm just a regular guy who loves options, and I try to learn as much as I can. So I'm here to share my experience. As for this particular topic, I think the same could be said for. If you just read the text, it could be said for any traders in general. Every trader can expect to wipe their account at some point in their life. And so it's really about, at least in my mind, is what is your expectation when you come to trading? Because whether you're trading options or you're trading Forex or you're trading commodities or even just stocks, if your expectation is that you're going to go and make quick money, easy money, then I agree with this statement. You're gonna most likely wipe out your account pretty quickly, because trading is like any other profession. You need to learn, you need to study, is the same way as you would learn skills for any other job. So it requires time and effort into it. So If you think that you're just gonna go and become an expert in 2 days and make money, I think that's a little bit foolish. As for if you put the time and want to learn and learn it as a business, like you will learn for any other profession, I think it's a different story. So that's kind of my 2 cents.
Thank you. Dan?
Yeah. Basically, I haven't seen this particular quote. I guess you found that online with some particulars about the way it's worded. It's the first time I've seen it here, like 1, 2, or 3 day periods. Well, that's not unusual, but are you talking about like new traders and they just start into the market and they're right in and they're, oh, lose 3 days in a row and throw in a towel and they were gone? Did it have any more? Do you recall any more details about the study that they did?
I have a feeling they were maybe more talking about day traders.
Ah, okay. Right. Well, or these days it might be a zero DTE trade.
Exactly. I think everybody's talking about zero DTE, and yet our members are not necessarily trading zero DTE trades. Do you have that impression?
Watching zero DTE trades, have not placed one yet because it seems to be almost like throwing pennies against the wall. You make your money and leave real quick. It's something that I do not really adhere to because your gamma risk, when we may talk about that a little bit later, is so extreme with such a short amount of time to go. And but on the other hand, agreeing with Rocco on the point of understanding what you're doing is the most important in the study side, and then yet even more important in my mind is actually trying to do the trade very small at first to actually get the experience in the market to find out where your emotional side is and whether you can stand to whether your losses or hold your losses, or does it keep you up at night?
Okay, I think also, let me suggest that the stats don't apply to us, hopefully. In other words, hopefully people in this kind of group or who seek any type of structured education are not necessarily the ones who are having their accounts wiped out so readily. However, be careful. Does anyone in the attendance, anyone of our membership, have some comments on this particular point?
Yeah, can you hear me?
Yes, we can.
Yeah, this is Jack.
Hi, Jack.
We look at options as a way to make money, and I know lots of option traders who have made money, including myself. And we do have at least one master option trader in the meeting today, and Ron Bertino. He can probably add more to it. But I use options not to make money, but to control risk. And that's a very different way of looking at things. So at the end, we do want to make money, but we can use options to manage risk. And that works out fabulously well.
So you're not actually trading options for their own sake?
I'm sorry, what? No. It's a combination of stocks and options put together.
But are the options only to hedge, or are you also taking full positions with the options?
I am taking full positions. If you're interested in it, I disclose my strategy on a free website. You can look at it. It's called jsafe.net. Just look at the presentation there. It'll give you all the details.
Great. Maybe you can talk to our group about it a little bit later. Any other comments? Okay, moving on. We have this issue as whether Thinkorswim is the be-all and the end-all of options trading for this class of trader that we have in our membership. Who wants to voice an opinion on that?
Dan, you want to go first?
Go ahead, Rocco.
I can go first. Well, from my perspective, I think it depends on what type of experience you have at the beginning. If you are really starting with options, I don't think that Thinkorswim is the easiest. It's I would say Tastytrade is probably one of the easiest platforms that I've seen. It's very intuitive, easy to use, but does not have a lot of the things that you might want to have when you get a little bit more experience with options. When it comes to understanding your positions, your T0 line, those are things that Tastytrade cannot graph properly. Thinkorswim is definitely better and more evolved. So I think it's a kind of good compromise between a full-fledged platform and something which is reasonably easy to use. And then on the full other side of the spectrum, you have Interactive Broker with their TWS, what is the name for? Trade Workstation.
Right.
Which is, I think in my mind, one of the most complicated platform they could ever come up with. Super comprehensive, a lot of functionalities, but the user experience is, I would say, quite bad. I know that recently they actually come up with a desktop version of it, which is kind of similar to Tastytrade, so it's actually quite nice. But again, I mean, I think Thinkorswim is kind of the sweet spot between the easiest but not too complicated, or EB, which is like super complicated but full of functionality. Thinkorswim is somewhere in the middle. So I actually like it a lot in general, and I use it for most of my trades. But yeah, it depends on what type of trade you are. I mean, if you're just doing simple spread, you may not need Thinkorswim. You might as well just use Tastytrade, and that's good enough.
So you're saying that Thinkorswim is better than Tastytrade in your opinion? Oh, I'm sorry.
Yeah, I mean, again, it depends on what you want. Like if you just need some simple execution and you're doing just spreads, you don't really look too much at the T0 line, which is what some people do. Then Tastytrade is probably your easiest way to go. Thinkorswim, I think, is more. It has a lot of the things that I actually like for real trading. So in my mind, is one of the best platforms that there is out there, given the functionality that it has, and that it's reasonably easy to learn. It's not the easiest, but it's reasonably easy to use.
But Dan, thank you, Dan. You've used both, and you've switched a lot of your trading now to Tastytrade, even though you were in control of Thinkorswim. Is that correct?
Yes, it is. I've slowly over time come to enjoy the swiftness that I can do a trade in the Tastytrade, and it's just because the way it's set up it's easier, quicker for me to execute trades, roll trades, adjust trades than it is in Thinkorswim. So I've migrated mostly to the Tastytrade world because of that fact. As far as some more sophisticated packages there for graphing and those sorts of things, I'm still in the Thinkorswim world. I still use the graphics package in Thinkorswim. Usually I create a chart per trade and then mark my put or call or exactly what's going on there, such that I could have maybe 15 charts up there. Each one is allocated to that position, and so I can glance at it at one time or have them all up on a second monitor. The Tastytrade allows a single chart and then what I call a quad chart. And so I find it a little less flexible for me there. But over time, that package is improving and getting more and more capabilities. But the presentations that I've given to the group before, I outlined some of the things I liked about it. I don't know whether we want to dive into that.
No, that's a good, excellent answer. And Michael?
I want to just say that Toss and Tasty Trade are not exactly like, but somewhat like the Brownie box camera and in the old days, everybody talked about the Leica camera. You can use the Leica camera with all its ring-ding facilities and capabilities. You can use it like a Brownie box camera if you wish to. It's a matter of attitude and approach to how you want to set things up. That said, I have used Tasty Trade, although not recently, and I'll be interested to take a look at some of the things that are currently available.
Yeah, thanks. Yeah, Dan is going to show Tasty Trade on the web with backtesting, and I'm sure he can answer some other questions too about Tasty Trade a little bit later, an hour from now, a little bit later in the meeting. Okay, so next one is, let me see, I already did that one. Okay, we did that one. Avoiding short positions. I mean, I think probably how rigorous should one be in avoiding outright shorts? I mean, I guess we got a couple of different definitions of short. Like some people might mean short just meaning that you had a bearish on the market, and that's not really what we mean when we say shorts are risky. We mean when you have a naked short, and more particularly a leveraged naked short. Typically in a lot of option positions, a lot of option strategies, you may have both short legs and long legs, and you can simply say you can count the legs and make sure that you have more long than short if you want to be conservative. But how risky is options trading on the short side? Is that the major downside to avoid in options trading?
Well, I did a 1.5 hour presentation, I think, a few weeks ago, talking about the risks of basically short positions. So I think my positions could be pretty clear. But I mean, in general, I think, especially if you're a beginner, being short or net short is a bit of too much of a risky for my personal taste. But different people have different risk appetite, so it may be good for others. So it's all about what's your risk appetite, whether you want to do it. Personally, I prefer not to. So that would be my just advice, to try to stay away from it, especially if you're at the beginning. And if you are, if you understand the risk, if you know what's involved in that, then obviously you can, as long as you can control your risk very tightly, then there is no issue. You can still do short positions, but you gotta make sure you have whether it's your stop or whatever your conditions are to manage your risk. That's probably as far as I'll talk about this.
Yeah,
Dan? Oh, sorry.
Yeah, I was getting ready to add to that, like what do you consider short? There's probably many different shades of gray here. Whether you're talking about a relative position where you're short a put and short a call, and between the two, you're almost neutral in a delta sense. Is that, are you talking about in a sense of delta or just in naked positions?
Well, where is the risk that people need to avoid? I mean, let's ask you the question.
Yeah.
In other words,
well, if you're wanting to cap the risk, is just in any short position, just convert it from a naked short position to a vertical or just buy the further out position
Yeah,
Yes.
but I think,
of an equal size.
but Dan, but I think at least my understanding of the question was, and maybe that's why I get it wrong, but it's about, to me, short position in this case meant that you are basically exposed to an undefined risk, not necessarily as a short delta, but more as a undefined risk where you're more naked, more short than long to a certain extent. So you're exposed to potentially unlimited losses.
I think it's better to define them as defined risk and undefined risk.
Correct. Yeah, that would be better.
So defined risk, you could be short, but you could be in a spread that's not too bad. Undefined risk would be to have just a single short call or a short put. Now, there are two strategies that actually work well with naked shorts. One of them is called the wheel strategy. That's a pretty popular strategy where you sell a put, you collect the credit, and if you are exercised, you get the stock, and then you start selling calls against it. So on an up market, that works fairly well. On a down market, it doesn't. So you turn from a trader to an investor. So you have to be careful with that. The other one that I have done fairly successfully is a ratio spread, where if you do on the call side, I wouldn't try to do it on a put side. It gets pretty dangerous. But on the call side, you're buying a long call, and above it, you're selling two short calls. Now, with every naked strategy, you need to know how to manage it if the trade runs against you. So naked positions don't work so well, just put and forget type of trading. You really have to know how to manage it if it goes against you. But I have made very good money using ratio trades, ratio spreads.
Okay, now just to be clarified that on the put side, that would be an extremely dangerous trade. But on the call side, arguably, I guess on a longer term trade, it would not be. On a very short term trade, it might still be. But yeah, those are two definitions of short. And one of them is extremely precarious if carried to excessive risk. Well, people just have to try and sort it out. I realize we haven't been crystal clear on that. Oh, here's one. Do you need to understand the options Greeks and to what depth? Rocco, you might as well go first on all these.
So I was just reading the comment that Ron made on the previous one, which is,
Oh, what did he say?
yeah, he said that most people are perfectly fine with selling out of the money calls on their stock positions. Yet they said that selling naked puts is a huge risk they would never take. Yet the two positions have the same risk profile. Yeah, exactly, because it's because of the put call parity. Basically, a short call and a stock is basically the same as a naked put. So yeah, and I totally agree, and it's actually quite funny. So, but I mean, if you look at just the wheel strategy that Jack was describing, I mean, that's a valid strategy if your intent is to potentially also own the stock. So again, it all comes down to what's your risk appetite and whether your profile is a little bit more risky or not. So anyway, going back to what was the question? It was about the Greeks, right? Whether you need to understand them.
Yeah.
I think again, if you're okay, my two kind of a super quick answer is yes, you need to understand them at least qualitatively. That you don't have to be an expert on all the quantitative aspect and everything else, but if you want to trade options seriously, you should understand the Greeks at least from a qualitative aspect. Understand what the impact is of those Greeks on your portfolio. But then there's people that claim that they have been profitable and they never understood the Greek. So that's not me. I think it's important to understand them, but I would say that yes, you should at least understand from a qualitative aspect. Then if you want to be more professional, you would understand also like the quantitative aspect and start managing them properly. But yeah, that's my position.
Dan, would you agree with that?
Yes, and yeah, if we ranked ordered them, I would do the delta and then theta and then gamma. And then
Mhm.
and then I would do the vega part. I would be especially attuned to the implied volatility of whichever option you were trading of that strike.
Yeah, I only put the gamma next to delta because it's related to it, but you're right, it's the no argument.
I just assumed it was maybe alphabetical.
Oh, that's true too. For let's say you're trading calendar spreads a lot, and of course, those automatically involve really all of these. Is that right? Or do you find yourself making use of all of these in trading calendar spreads?
For
Or
me,
spread,
no.
or do you or you don't do calendar spreads? Am I wrong?
I'm still developing my second nature on calendar spreads, or my gut feel, because some of the tools, because of you're in different months, it's harder to calculate, and
Yeah.
so
Okay.
I'm in the stage of experimental calendar trader.
Okay. That has a reputation of being extremely difficult to manage, people to grasp.
Take a look at diagonals. They are more forgiving and more manageable.
Yeah. And the diagonal is a form of time spread, but with different strikes.
Dan, I'm curious about, you said that you will leave Vega as the last of the Greeks. I'm curious as to why. I mean, if I look at gamma, I mean, gamma risk becomes very important when you are in the short dated options, right? If you go far dated options, gamma risk is kind of well, definitely lower in my priority list. But if I were to kind of rank order them, I would say delta and vega come first, then theta, and then gamma. The reason for theta being a little after is that basically theta, I know if it's positive, I know that I'm making money. If it's negative, I know that I'm losing money every day that goes by. Other than that, the higher the theta, the higher the risk in general, because it means you have a lot of shorts at some point. But beside that, to me, vega is probably one of the most powerful Greek that can really burn all your income. So I would say, I mean, Vega is super important to understand. So Delta and Vega are, in my mind, are the first two, but I'm curious as to why you would put it as the last one.
Okay, yeah. Go ahead.
The reason I'm that way is normally my objective, not always true, but the objective is to get out of the trade before the gamma becomes so great near expiration. So other than earnings trades that possibly expire a few days away, I'm willing to take the gamma risk in that. If you don't want to take the gamma risk, I'll trade it 30 days out or even further.
Yeah, well, as Brandon points out, it really depends what you're trading the most, and which number is bigger, which number is varying more for your particular trade. For earnings trades, it's different from certain other types of trades.
Yeah.
Rick, you said rho gets no respect, and rho is what with respect to time, is that right?
Interest rates.
Interest rate, okay.
It's because the effect of interest rates, it's, well, first of all, interest rates don't change that much during the life of the trade. Even if you, I mean, this past year, we only seen an increase of 0.5% in the interest rate over an entire year. Now, sorry, a decrease recently, although the rates have been going up, but the effect of that increase in the interest rate on the running position, I would say, was relatively little compared to the effect on the other Greeks. Now, what's important to me is more like what is the interest rate at the time of entry, because that has an effect. If you look at, for example, at the calendar, And if you have a calendar where interest rates are zero, you would see a fully symmetrical shape of your calendar. But if you take a cold calendar and the interest rate goes up, you'll see that the right side of the calendar starts becoming higher. So basically, the interest rate has an effect on your strategy and in your position and and changes your delta at the time of entry. But once you're in, I don't know that it makes a lot of a difference. So that's why I kind of tend to not to completely ignore it, but it's less powerful in my mind.
Yeah, it was really great to have been able to ignore it for so long, but just because on the mathematical side, it's a lot simpler. But now with interest rates rising or have risen, although they may now be peaking, it's a little more relevant. Excellent. Okay, let's see. Okay, let's see. I've gone through this here. Okay. Here's a really important question that there's an awful lot of people doing earnings trades. And I'm still puzzled because a lot of them seem to be successful. And yet, why does the efficient market hypothesis or theory not apply? In other words, why are there not enough participants in that market and to even it out so the pricing is efficient? But Dan, would you say that you have proved in your own trading that there are real edges to be found in trading earnings?
If you go about the selection process of sticking to, let's say, truly liquid stocks with some high volume to it, and then again selecting only those positions that have a relatively high implied volatility. And there's this things that we've talked about before, IV rank and an IV percentile. And by IV rank, it's just where does it rank relative to where it's been in the past historically. And so if you have an IV rank of, say, like 80 or something of that order, that is very attractive, along with a strategy that is selling options, because you know the implied volatilities as soon as the earnings are announced, the implied volatility is just crushed within, say, an hour or two, and unless you're if you did both sides of a trade like a strangle and the stock moved towards your strike and it's really right at your strike, then it will become dependent upon the time left in the trade. If it's only a day or two left, you can be right there at the near the strike or slightly over the strike and still close it for a profit and be gone. But so the strike selection is one where I usually try to look at the calculated market move. The market maker move is on the TOS platform there, and then calculate that, and then take and multiply it by at least 1.5 times, possibly 2 times. And at a 1.5 times the market move, you'll end up somewhere around a standard deviation, typically, on the short-term trades.
Yeah.
And so with that maneuvering, I do it and win most of the time.
That's great. That's great.
My problem is, like all problems, is you get greedy or you think you know something, and you hold on to the trade instead of taking the loss and moving on.
Sure.
And then holding a position. I've held positions for a year, not admitting defeat, and then making a nickel in the end.
Well, that's victory. It's still victory.
A scratch is a scratch.
Rocco, do you buy that there's a real edge to be found in earnings trades, and if so, why do you think there is one?
I think the edge is not in the efficient market hypothesis. I mean, the efficient market hypothesis still applies to earnings and as well as everything else. If you think about it, what it says is that all news have been priced in. Essentially, all the information is already readily available in the market. That's why prices are already efficient. But when you look at the earning event, you know that the earning is coming. And so that's what's being priced in, the fact that the earning is coming, but you don't know what the result of the earning is going to be, right? So the market can still be efficient, yet you don't know what the answer is. The uncertainty is not on the fact that the event is coming, is in what's going to be the outcome of that event, right? So the efficient market policy still applies. Having said that, the strategy, in my mind, the edge is in the strategy itself. You could be trading directionally. So you could be betting that the stock is going to go up or down. So you position the delta positive or negative position depending on your assumption. You could be trading on the, as Dan described, on the vol crash that is going to happen after the event. And so you would trade the delta neutral strategy, which has a high implied volatility. And then after the vol crash, you profit from that, hoping that you don't get blown on your delta once the earnings out and the underlying moves maybe too much. You could be betting on an increase in volatility on the period that precedes the earning. So implied volatility is going to increase usually 2 to 3 weeks prior to the earning event. You will see the volatility started to increase. So calendar positions, certain type of calendar positions could actually be profitable by you enter 2 to 3 weeks before the earning event and you close 1 or 2 days before the earning itself. So you never actually go through the actual earning. So there's different strategies essentially to play these things. So they can be profitable. Now, I don't know whether this is something that could be profitable in the long run as an income strategy. I don't think that that's the case because you're always subject to these binary events where you think the market is going to do something and the market does something completely different. Meaning that you think that you see a lot of times where a company posts fantastic earnings and then the stock crashes, right? So sometimes seems to be like completely unrelated connection between what the company is doing and how the stocks is behaving. So I don't know if that it basically leads to a profitable strategy in the long run. But as for individual events, I mean, I think yes, they can be profitable, and there's nothing wrong with the efficient market policies.
That's fascinating. So I think there might be a slight disagreement there, which is great. And
Well, let me say another thing. I've been searching for it, but have not been able to find it. And it's an Australian study where apparently it is they were able to give the earnings announcements prior to the market opening to a certain number of traders, and to see if they could take advantage of knowing about what the earnings were prior to the announcement. So they gave it to these traders in Australia, and they made their trades. And in the end, the people who made money and the people who didn't make money was about a 50-50 split, to Rocco's point there. So earnings are good and the stock goes down, and based on a lot of other things inside of just the earnings, but their outlook. But if somebody has run across that report, it's supposedly fairly recent. I'd love to study it. But as far as the earnings themselves, the reason I got into it early on was a time period of lower implied volatility, and the earnings events were a way for me to get an action quickly and get many more occurrences done to get the replication of many trades faster. And so every 3 months you get a chance of going through this opportunity of making a lot of trades. and
Okay,
clear.
excellent.
One-
Go ahead.
One strategy that I heard that works relatively well, though you could lose your shirt if you're not careful, is just when the IV is high just before the earnings. You look at whatever period you're looking at, whatever DT you're looking at, and TOS will tell you what the expected move is. You could do like a 1.5 standard deviations away, but you basically do an eye in condor. So you're not sure if it's going to go up or down. Even with good earnings, stocks have come down. So you're collecting credit on both sides, but the critical part is to manage it when there is a big move. So when either on the upside or the downside, when your short is around 40 delta, you buy the short back. Yes, it's very expensive, but assuming that the price keeps on moving in that direction, you have a long in that direction, whether it's put or a call, and that would more than make up for the cost of buying a short position and paying a lot of money.
Okay, now we're sort of getting into the details about earnings trades, and that shows there's a lot of interest in it, and we'll have to come back to that
Okay.
in another meeting.
Okay. I'll stop making them.
No, I think Jack made a good point. I mean, look, the point that Jack is bringing though is at that point you become very directional. So the moment you buy you buy back your short, first of all, you paid a lot of money for it. And second, you're now very directional. So if the market doesn't move that direction you think about, you take the loss twice, right? So it's kind of it's a bit of a risky. I mean, Ron brings a good point that basically trading the earning event itself is a little bit of a gambling because they're called binary events because it's literally like a flip of a coin. You don't know which way it's gonna go. So yes, you know that there's gonna be a vol crash. That is the only thing that you know that is going to happen. Other than that, you don't know how much is gonna be your delta, how much is gonna move up or down. So that's the challenge with the earnings.
Yep.
If you go into the position and when you first open the position, you're near a zero delta. So your exposure is about equal on both sides. Because I certainly do not know which way the stock's going to move after the earnings. And I just count on having both sides on and managing it in a way is if the stock goes up too high, then I'll roll the put up in the same month or same strike time period, roll it up toward the call and collect more premium and keep doing that. And then if it's only a few days to go, then roll it out in time and do the same sort of thing.
Okay, and moving on to the next one, resolved quantitative analysis should be part of all options trading. And Michael Rolson says, define quantitative analysis. Basically, I guess the way to put this is another question I have is what type of quantitative analysis do we all need to be able to handle? And as let's say you have an options trader who is not primarily quantitatively oriented, what basic quantitative skills does he need, Rocco?
Well, let me just by saying that you could live without quantitative analysis, just as long as you understand at least qualitative, the Greeks, as I said before. And you need to have a good qualitative understanding of your options and your position, how they change. And obviously, I mean, it depends on how much quantitative, well, what do we actually mean by quantitative? I mean, does it mean statistical analysis or do we just mean doing simple arithmetic to understand the total sum of your Greek exposure? I mean, those are two different ways of looking at this. To me, quantitative analysis is about statistical analysis, is about deep backtesting, understanding your positions and kind of employing statistical tools to understand this. rather than just looking at the the overall qualitative position and the charts. So that's my interpretation of quantitative analysis. Other people may have different aspect of this. Now, how can someone who doesn't know statistics live with it? Well, you can use there's a lot of backtesting software. There is, I mean, not a lot, but there's a number of backtesting softwares that are point and click, right? And I think Dan is going to show also one of them today. I haven't seen, honestly, tested trades backtesting recently. The first one that they did was fairly primitive, to the point it was too primitive for my taste. But the point is, you can use some backtesting technology to help you out understand the position. You can maybe learn a little bit of Excel to keep up your trade and do some simple averages. That could be good enough, I would say. But if I might add, having a little bit of understanding of how averages work, or how a little bit of statistics. I know it sounds a little bit scary, but it can help understand. I mean, in the long term, if you're trading for a long time, right, you need to do a lot of trades before you actually converge to a long-term expectation. And so having a little bit of a statistical background can help. You don't have to become a statistics wizard, but just some, simple basic knowledge.
Excellent. That answers, I think, Michael's question.